Hello everyone, welcome to the channel The Formula for Success and Wealth, where you learn how to build wealth and live smart. Most of us have heard that investing is essential if we want to become wealthy, but very few people explain exactly where that money should go. That's why today I want to talk about 5 different types of assets you can consider, starting with stocks, then real estate, businesses, cryptocurrencies, and finally, gold. This way, you can better understand the various types of assets available to invest in and how they can generate returns. The real path to wealth doesn't lie in earning a high salary, but in converting the money from your job into income-generating assets. After all, there's no cap on how many assets you can own or how much income they can produce. The only thing with a limit is your time. And that's precisely why a change in mindset is necessary, shifting from being a consumer who works only to spend to becoming someone who works to acquire assets and then uses those assets to fund their lifestyle. That's what wealthy individuals do. They earn money to acquire more assets, and it's the income from those assets that covers their living costs. In contrast, those who are in debt, which includes a large portion of Americans, work simply to make money and spend it, whether it's buying a new car, financing a bigger house, or paying for another vacation. But no one builds real wealth that way. If you want to become rich, you must focus on acquiring assets and allowing them to generate income. Income that isn't tied to your direct labor. Income that continues to flow even while you're on vacation because the assets keep working. The big question then becomes, what assets should you invest in? That's what I'll be talking about in this video, starting with stocks. When people think of the stock market, they often imagine finding the next Amazon. But that's not the only way to earn from stocks. And in fact, that mindset often leads people to lose money, chasing after the next big thing without a long-term strategy. This impulsive behavior of jumping on trendy or meme stocks often results in losses. And that's despite the stock market's track record being positive over the last 100 years, even with frequent crises and downturns. Still, many prefer to chase trends instead of focusing on consistent investing. It's important to distinguish 3 categories. First, the different instruments in the market, like stocks, index funds, mutual funds, and ETFs. Second, the difference between assets that generate cash flow and those that don't. And third, your personal strategy, whether it's passive or active. Let's break down the difference between stocks, ETFs, mutual funds, and index funds. When you buy a stock in a company like Amazon, you're betting on that one company and assuming all the risk that comes with it. That's how most people see the stock market. They think success is about picking the right company. But for 90 to 95, maybe even 98% of people, it's not recommended to invest directly in individual companies. That's because doing so requires keeping up with everything about the company: quarterly earnings, financial statements, innovations, competition, and strategy. If you don't have the time, interest, or knowledge to stay on top of all this, it's far more likely you'll make poor decisions, like panic selling or buying on impulse. On the other hand, when things go well, the profits are yours. If Amazon dominates the market, the stock price increases and you profit. But if the CEO makes poor choices and the company collapses, the loss is entirely yours, and that's not easy to accept. A safer alternative is investing in funds. There are 3 main types: index funds, mutual funds, and ETFs. Index funds are considered passively managed because algorithms control them, which significantly lowers fees. They give you access to a basket of stocks, like the S&P 500, which includes the 500 largest US companies. If one drops out, the system automatically replaces it. Index funds target various sectors. Beyond the S&P 500, there are ones tracking the Dow Jones, Nasdaq, healthcare, and many others. Generally, these funds have 3 characteristics: lower fees, limited to one trade per day, which reduces volatility and speculation, and a minimum investment amount, which could range from $500 to $5,000. Mutual funds operate similarly, but are usually actively managed by a fund manager. This manager aims to beat the market's performance. On paper, this sounds ideal, but in reality, the added cost rarely pays off. A study by Moody's found that in about 75% of cases, fund managers failed to outperform the market. So, those who invested in low-cost passive funds often earned more. Mutual funds also allow trades only once per day and usually have a minimum investment amount, just like index funds. ETFs, however, are a hybrid. They can be passively or actively managed, depending on the product and trade, like stocks. That means you can buy and sell them throughout the day. Another advantage is that ETFs often don't require a minimum investment, letting you start with smaller amounts and more flexibility. So which one is right for you? That depends on your goals. Personally, and remember to do your own research, I prefer ETFs because they're practical, easy to buy and sell, and fit my profile, but it's crucial that you know what your investment objective is. I, for instance, like assets that generate cash flow, not just ones that increase in value, but ones that also provide income while you wait. In the stock market, this is called a dividend. Some companies share a portion of their profits with shareholders, which usually indicates financial health. When a company earns profit, it has three choices: save for emergencies, reinvest in itself by expanding or funding innovation, or distribute the profits to shareholders. If it chooses distribution, you receive a payment just for being part owner. If you own a share in a company, you own a piece of it. When that company pays out profits as dividends, they're essentially sending you money, typically via direct deposit to your brokerage account, just for being a shareholder. This happens without you needing to do anything beyond holding onto the stock. It might sound appealing, but it's important to understand the pros and cons. First, dividend-paying companies tend to grow more slowly in stock price because instead of reinvesting profits to expand, they're giving it away to shareholders. Second, dividends come with a tax burden. Even if you reinvest them, you still owe taxes on the received amount. For example, if you receive $1,000 in dividends and reinvest it, you still must pay taxes on that $1,000. The good news is that qualified dividends are usually taxed at lower rates, known as capital gains rates, which makes this type of income more attractive compared to wages. But this brings us to the big question: what do you want from your investments? Are you looking for cash flow, or are you more interested in capital appreciation? If you're investing in high-growth companies, like startups, it's unlikely you'll see dividends. That's because startups prioritize rapid growth and market share, so they reinvest everything they can. If your goal is to see a significant price increase in your stocks, dividends may not be the best route. However, if you prefer more stable and predictable growth, dividends can be a good option since they provide consistent income. That's why choosing a strategy that matches your profile is essential. In my case, I value cash flow. That's why about 75% of my entire investment portfolio, not just stocks, is in income-generating assets. Among my stock investments, I hold many ETFs that provide that kind of return, plus shares of companies that distribute profits. Not all my investments produce direct income, but most do, because that's my priority. The advantage of cash flow is that it continues to come in while you're sleeping, traveling, or relaxing. I want my assets' returns to fully cover my lifestyle, which reduces my financial stress. Another important aspect is understanding what kind of investor you want to be: more passive or more active. An active investor chooses specific companies to invest in and monitors their performance over time. A passive investor sets up an automated system to regularly buy shares in funds like ETFs, mutual funds, or index funds, regardless of market conditions. It's a more consistent and automated approach. You don't have to choose only one path. In my case, I use both. I have a passive system where every Wednesday a set amount is automatically invested in ETFs, and I also make active investments looking for opportunities in individual companies. This system continues regardless of whether the market is up, down, or in crisis. The only exception would be a major market drop. In that case, I might invest a bit more. This combination works for me, and you need to figure out what suits your situation based on how involved you want to be. Now let's look at some examples of dividend-paying stocks. Again, I'm not recommending any specific investment. At the time this video was recorded, Verizon was offering about a 7% annual dividend, McDonald's around 2%, Bristol Myers in the healthcare sector about 3.2%, and Apple roughly 0.5%. This means if you invest $100 in a stock that pays a 7% dividend, you'd receive $7 over the year just for holding the stock, regardless of any change in its price. That percentage may vary, but what truly matters is the actual amount you get paid. These payments usually happen quarterly, meaning every 3 months you get a fourth of the annual total. If you'd rather not invest directly in individual companies, you can also look at ETFs. Here are a few examples, just for illustration. The SPY ETF, which tracks the S&P 500, an index of the 500 largest companies. In the US stock market, American-based ETFs currently yield about 1.5% annually in dividends. By investing in this ETF, you're gaining exposure to the 500 largest companies in the market. The DIA ETF, which mirrors the Dow Jones Industrial Average, comprised of roughly 30 companies across various sectors, is offering an annual return of approximately 2.8%. This is one of the most recognized and frequently referenced indices in the stock market. Another example is the QQQ, which tracks the Nasdaq index, composed of 100 major non-financial firms, mostly from the tech industry, and it currently delivers a yield of around 0.6% per year. Then there's VYM, an ETF targeting companies that distribute high dividends. I personally have money in this fund, and it's returning just over 3% per year. It's designed for those who are interested in cash flow, as it focuses on businesses that reliably pay out dividends. Before moving to the next asset class worth considering, it's worth noting there's a free ebook from Market Insiders that walks you through how to start investing, generate cash flow, and build a portfolio, even if you're starting with very little. You can find the download link in the description. The second class of assets to think about is physical real estate. This is one of my favorite places to allocate capital. When you buy property, you're acquiring something tangible. It might be a house, an apartment, a commercial building, an office space, a store, or a mixed-use asset. This form of investment requires more money and effort, but it gives you ownership of something concrete and ideally income-producing. People invest in real estate for various reasons, but for me, the main goal is generating cash flow. When I purchase a property, I'm not speculating on whether it will appreciate in a year or 5. My decision hinges on one metric: how much income will this property produce this year, next year, and beyond? It's a straightforward formula. If I put $1 to work today, I want to know how much it will pay me annually moving forward. That's the basis for my evaluation. I avoid making decisions based on appreciation forecasts because future value is unpredictable and poses significant risk. What I can forecast more accurately is the rental yield, estimate expenses, and calculate monthly profit with reasonable certainty. If the returns are good, then I consider it a viable deal. My personal target is a 7% net annual return on the invested amount, meaning each dollar should yield 7 cents in annual profit after all expenses. If I invest $100,000, I want it to bring in $7,000 a year net. I receive thousands of dollars annually directly into my bank account from rental income alone. If the property appreciates, great. It's a bonus. If values drop, that's also fine, because the income stream remains. The reason I prefer this type of return is that if we enter a recession or economic downturn and I need to reduce rents, there's still enough buffer to remain competitive and avoid losses. A major issue in real estate during economic cycles is over-leverage. People get excited about a certain area or property, overpay, and take on high expenses. Overpaying leads to larger loans, which means higher monthly payments. Property taxes also increase since they're based on assessed value. Insurance premiums rise too because the insured value is higher. So when someone pays too much for a property, costs increase across the board. If things go south, rents drop or vacancies rise, it doesn't take long for that person to fall behind financially. That's why treating real estate deals like guaranteed wins is a risky approach. Unlike stocks, where you're buying into a company and the CEO handles operations, with property, you're in charge of everything. If I invest in a company like Amazon, or a fund like the S&P 500, someone else is managing it. But when I buy a rental, I'm responsible for its performance. Personally, I don't manage any of my properties directly. I hire companies whose job is to handle everything: finding tenants, screening them, collecting rent, managing repairs, paying bills, and ensuring the property is in good shape. Having a skilled property manager makes a huge difference. It can simplify your life dramatically. On the flip side, a bad manager can create chaos. This is one of the early hurdles in real estate investing. Many people paint an easy picture, buy a property, hand the keys to a management firm, and wait for money to roll in. That's what I was led to believe at the beginning, but the reality is much different. I had no one to guide me. I didn't, and no other investors. I had to figure everything out myself. Books made it seem easy, but the early stages are actually tough and time-consuming. You need the right people: a solid realtor, a reliable property manager, a good contractor, a trustworthy real estate attorney, a specialized accountant, an experienced inspector, and even some understanding of how to deal with municipal authorities. There's a lot to learn. But once you push through that learning phase, find the right team, and learn from your sometimes costly and stressful mistakes, things start falling into place. For me, the process is much smoother now because I have a trusted team. It wasn't always like that. The first few deals were the toughest. For me, the first 3 properties were the biggest challenges. After that, it got easier. If you're willing to endure that learning curve and face the difficulties, your odds of success grow significantly. But it takes commitment. Another concern people have is cost. Real estate investing does require more capital. It's a matter of priority. What I've found is that when you prioritize real estate, you find a way to make it happen. It might take months or even years, but if it's your goal, you'll start saving toward it. The upside is that once you become a real estate investor, you gain a stable income source. It's a tangible asset that provides ongoing cash flow. Plus, there are several tax incentives available. As a licensed attorney, though not yours, I can tell you the tax code heavily favors real estate investors. You can deduct depreciation, operating expenses, and other legally available incentives if you're operating as an investor. You can make money and legally reduce your taxes with real estate and even sell for a profit while deferring taxes. For instance, say you buy a property for $200,000, hold it for 5 years, and sell it for $1 million. That $800,000 gain is normally taxable, but through a strategy called a 1031 exchange, you can reinvest the full amount into another Larger property that produces more income and profit and delay paying taxes. This benefit doesn't exist in the stock market. If you buy stocks for $200K, sell for $1 million, then buy more stocks, you still owe capital gains tax. Real estate has specific rules that don't apply to other asset classes. However, it's essential to consult professionals before doing this. The process has legal requirements, so you'll need an experienced accountant, a trusted attorney, and a 1031 specialist to help guide you. Real estate income can support your lifestyle. When I started my financial journey, I realized it was possible to earn money without working directly for it. I used to run an event business, and I only got paid if I was organizing events or weddings. Then I rented out an apartment for $600 a month and started earning passive income. It wasn't entirely passive. I didn't yet know how to make it so, but I could see the potential. I figured the key was to accumulate more properties that delivered the same results. If each one brought in $300 a month, how many would I need to cover my lifestyle? 10? 20? 100? From that point on, I focused on acquiring units and stacking that monthly income until I built a steady stream of revenue that no longer required me to actively work for it. A third path to building wealth is investing in businesses, either your own or someone else's. Most of my investments go into businesses I own. I don't even view this as a traditional investment because I'm directly involved. For example, Briefs Media, my newsletter company, is an active investment where I operate as CEO, managing the day-to-day and driving its growth. So when I invest money there, I'm actively growing that capital, and this is another route to generating wealth. These days, investing means putting my money to work, not necessarily in real estate or stocks. In fact, I've been allocating fewer resources to both sectors in recent years to have more capital available for my business. My goal is to scale the company I'm building. When you invest in stocks or real estate, you typically aim for a 7–10% annual return, which is excellent long-term, especially if you're a passive investor. But with your own business, the upside is limitless. Of course, the risks are higher, but you also get to develop your own creation. In my case, Briefs Media has a much higher growth potential right now, which is why I'm investing more into it. This strategy suits me because I'm an entrepreneur. That's my nature. I accept the risk of losing everything I've invested, including the time if the business fails. But I face that risk head-on. If you're not an entrepreneur or don't have a business idea to bet on, that's okay. You can still invest in other people's ventures. One option is to back startups, which I began doing around the pandemic when startup investing became more accessible thanks to crowdfunding platforms. New regulations now allow anyone, including you, to invest in startups starting from just $100. However, it's critical to understand that this kind of investment carries a high likelihood of loss. Around 80–90% of startups fail or go under within 5 years, which means most of the companies you back will lose money. You need to keep that in mind from the beginning. The goal, of course, is not to lose money. The idea is that when you hit on a winner, the return. I genuinely enjoy this area. I like being close to entrepreneurs and contributing to the growth of businesses I'm involved with. Even though I haven't invested as much in this sector as I'd prefer, I've backed a few startups. There are platforms that simplify this process. And just to be clear, I'm not sponsored by any of them. One of them is WeFunder, where I'm actually an investor. The other two are Republic and Start Engine. These are 3 platforms you can use to invest in startups. The return on this type of investment only happens if the company gets acquired by a larger one or goes public and starts trading on the stock market. If neither of those happens, there's a chance you'll never see your money again. And if the Company fails, your investment is definitely lost. It's a high-risk move with significant upside potential because you're backing a business still in its early stages. This type of investment could be part of your portfolio, but likely shouldn't make up the majority, especially if you're just starting out. Still, it can be a meaningful way to support small entrepreneurs as long as you understand the risks involved. Another area where capital can be deployed is cryptocurrency. These assets are highly speculative and known for their volatility. In my overall portfolio, 80% is allocated to stocks and real estate. Setting aside my own business, that's where most of my capital is focused. The remaining 20% goes toward higher-risk ventures, such as startups, cryptocurrencies, and precious metals like physical gold. You need to find a balance that suits your own circumstances. Cryptocurrencies fall into the speculative category because they can either drop in value dramatically or rise just as quickly. I like them because I've personally experienced their usefulness. I work with contractors outside my country, and in the past, sending them money was expensive and complicated. At one point, I had to use a traditional bank that required me to be physically present just to process international transfers, which was slow and cost between $40 and $45 per transaction. I happened to be traveling in California at the time, and my bank didn't have a local branch. One of my contractors needed to be paid, but his country didn't support PayPal, and alternatives like Payoneer, which has since rebranded, didn't function there either. Things got tricky. I asked him if he accepted cryptocurrency, and he said yes. I sent the payment, which arrived in seconds, and the fee was only a few cents. That experience changed the way I view money transfers and even the concept of money itself. That's why I still hold cryptocurrencies today. I don't go for obscure or small tokens. I focus on the major ones like Bitcoin and Ethereum, with rare exceptions. But my main focus is Bitcoin. To me, it's a bet on the future. I believe in blockchain technology, but I'm also fully aware of the risks. If I lose everything, I'm okay with it. If it appreciates significantly, great. It's part of the riskier side of my investment strategy, but it's something I believe in. My approach remains consistent. 80% of my portfolio is in stocks and real estate. 20% is in startups, crypto, and gold. Which brings us to the fifth area of investment, precious metals, particularly physical gold. I own a small amount of real gold, and by physical gold I mean the actual metal, not ETFs or paper-based assets backed by gold. It makes up about 2% of my portfolio. I buy a bit each month and leave it at that. The goal isn't to profit from price increases. In fact, I don't even track the market value. For me, gold is simply an alternative way to store money. I see it as a hedge against extreme situations. If I buried $50,000 in cash and another $50,000 in gold in my backyard and returned 10 years later to dig both up, I'm fairly certain the gold would have more purchasing power than the cash. That's why I view gold not so much as an investment, but as a method of value preservation, a protective measure for worst-case scenarios. These are the 5 main areas where I put my money. Let me be clear. Don't blindly copy my strategy or follow someone online without doing your own due diligence. In my case, I invest in my own business and startups, physical real estate, stocks, cryptocurrencies, and physical gold. If you made it this far and want to master the secrets to investing wisely, don't miss our special video, Millionaire Reveals the strategy no one tells you with $10,000, link in the description. In that video, I share practical strategies to help you start without fear, diversify properly, and protect your money even during economic turbulence. Did you enjoy this content? Then make sure to subscribe to the channel, turn on the notification bell to stay updated, and share it with someone who needs these tips, because financial freedom is a collective goal, right? Let's build a future where every cent you earn works for you. See you in the next video.